Good afternoon. It's Tuesday, July 8th. I hope everyone had a good July 4th. I was upstate. We took our kids uh, north of the Hudson Valley in New York. A lot of swimming, a lot of barbecue, a lot of hot, cold. It was get hot. It was a hot summer day. Jump in the pool, get cold, get off dry again, get hot again. I took them out to Stewart's ice cream. I grew up with Stewart's ice cream. Truly is some of the best ice cream out there. The butter pecan, can't go wrong. That was a lot of fun. Mistakes were made. A lot of calories. I want to embark on a 5-day water fast. Anyone wants to join me, let me know. It's easier to do those things as a group. I talked to a friend of mine who just enrolled in Dr. Peter Attia's concierge medical plan. He just did a glucose monitoring test for glucose sensitivity, and it reminded me of during COVID, I was just testing all these different strategies around longevity. And I got to get back into that. I think I'm going to try an NAD infusion this Wednesday in New York. Haven't done that in a while. That'll be good. Your instincts just get better with NAD infusion, I've noticed. Like the instinct to go to the gym in the morning gets better. It's not even a conscious thing. It just becomes an instinct that you're presented with. So anyway, I hope you had a good one. I shared some reflections over the weekend on Independence Day. Briefly, I don't know how there's no July 4th movie that celebrates the American Revolution. It's a big gap in the market. Someone with Google VEO3 should go build that. Build it for $8,000. And, actually the technology's not there to do it yet. Technology isn't there. Believe me, we tried. We built this VEO3 video. You can check it on my profile on Twitter. Got 100,000 plus views. We paid $700 to do it. My super intern, Lev, who we're going to extend an offer to, he's a sophomore in college. He built it. And it goes to the point of this Wall Street Journal article today about how high agency people stand to benefit with AI. Well, I think more broadly, it's startups and founders, small, nimble organizations are going to benefit tremendously from AI. And you're going to see significant bifurcation. You already have bifurcation in public markets and private markets. That's only set to accelerate. Some topics I wanted to get into today, AI, public markets, some thoughts around what we're seeing there, tax cuts, breadth expansion, digital assets, Robinhood, Coinbase, stablecoins, and Apollo, Alberta oil and gas. Some stocks I'm looking at, themes. It's too much. I'll do the best I can. There's so much we look at every day. Lumida analysts, when they go to the party, they're like the life of the party because their job is to track all these themes. We have AI that's reading the front page of 6 different newspapers every day. We have another AI that's grabbing news from Grok, organizing that by theme. There's a lot happening out there in the world. It's a lot of fun to make sense of it. And let me share with you a few thoughts. I did want to lead off with this. We got a new habit going. I'm going to try to stick with it. Pick a book off the bookshelf, share a passage. This is from Ray Kroc, founder of McDonald's. The title of the book is called Grinding It Out. Grinding It Out. What a headline. Is that not the startup journey? Is that not the founder journey? Grinding it out. That's what it's about. A lot of people want to build a business and just kind of coast. I think they're more interested in raising money and getting on the cover of a magazine than actually building a business and executing. Real execution is about grinding it out, one foot in front of the other. Mostly suffering. That's what entrepreneurship's mostly about. It's a great book. There's a wonderful movie called The Founder. Based on this book, I interviewed Don Hadfield on my show last year. If you want to listen to it, very, very thoughtful producer. We're talking about tokenizing royalties. There's so much to do out there. Tokenizing royalties, structured products, payments that are conditional on states of things in the world. Seems ideal for stablecoins. But take a look at this passage. So I'll read here. McDonald's doesn't confer success on anyone. It takes guts and staying power to make it with one of our restaurants. At the same time, it doesn't require any unusual aptitude or intellect. Any man with common sense, dedication to principles, and a love of hard work can do it. And I have stood flat-footed before big crowds of our operators and asserted that any man who gets a McDonald's store today and works at it relentlessly will become a success, and many will become millionaires, no question. One of our fine old-timers, Morris Goldfarb from Los Angeles, said at the 1976 Operators Convention in Hawaii that he was certain research would show that Ray Kroc has made millionaires of more men than any other person in history. Ray himself is more humble. He goes on to say, I don't know if that's true, but he said, I'd rather say I gave a lot of men the opportunity to become millionaires. They did it themselves. I merely provided the means. What an extraordinary story. I know McDonald's isn't Cava anymore, but it's an extraordinary brand. And if you think about the debate that's happening around there around socialism and capitalism, I mean, we need 100 more Ray Krocs. We need 1,000 more Ray Krocs. We need 10,000 more Ray Krocs and more Steve Jobs and more entrepreneurs and more founders. That's how you solve problems. That's how you solve problems. So I'm trying to shine a light on capitalism and entrepreneurship. It's a force that makes the world better, raises living standards. There was an old expression about McDonald's. When two countries have McDonald's, they never go to war. I think that was mostly true until Russia-Ukraine, possibly. So let's get into this. So public markets, I mentioned on Sunday that if there was a time for the markets to have some softening or weakness, it would be now. Amazingly, the markets seem to have wrung out some of the excess pretty quickly. Some, more constructive going into earnings season. And earnings season will start off with the banks. Next Tuesday, JP Morgan and the big banks will report. I expect they'll report well. I've been talking about financials for a while. A lot of deregulation that's taking place. More capital relief is coming. And banks all over the world are doing well, especially in emerging markets. In the UK, in Brazil, in South Korea, in Japan, in the United States. Banks all over the world. Bankers around the world rejoice. It's an interesting thing. I'll share a bank we own in Brazil today. But I own many banks. Small positions in a lot of banks. So one of the things we're noticing is just the movement of speculation from speculative markets like digital assets to public equity markets, right? You're seeing things like Circle and the CoreWeave IPO and IPO season is really attracting a lot of interest and attention. You're seeing Bitcoin miners take off. I mean, things are starting to attract Cathie Wood kind of vibes. This is the season of Cathie Wood that's going to be upon us soon. That's my sense, anyway. I think perhaps in the next few weeks, certainly has been the last few months, and going into Q4. I've noticed Cathie and her team, they've changed their approach to picking stocks. Like, they actually have companies that grow earnings now. So it's a shift. It's a start. It's a major shift and improvement for what they were doing before. So we'll see. I think those kinds of themes, they actually own businesses that, are on theme. I'm not saying necessarily like all of them. I don't, but there's some credibility around what she's doing now. That's an observation I wanted to share with you. Robinhood and Coinbase, I think Robinhood, Coinbase, Palantir, you look at what's happening in the markets, I think you're starting to see rotation from names that rallied the most off the bottom, particularly growth stocks, into these catch-up and mean reversion ideas. So you're seeing large cap tech lagging today, and you're seeing small cap value rally. That's something we've been noticing the last couple of weeks. Half of my portfolio is in small caps, actually. Small caps with earnings growth, good quality, momentum often as well, and themes that we like, and different leaders in different categories. We can talk about some of those names if you want later today. So Competition's increasing. Robinhood, Coinbase, Kraken is on the scene too. Seen a lot of Me Too copycat, behavior in terms of the new product offerings around tokenization. Really excited to see tokenization. Been a big fan of tokenization. Uh, there's still more to be done. There's still more to be done around product market fit and the asset classes that will benefit from tokenization. The scope of opportunity around transforming capital markets, infrastructure, payments for businesses, consumers, cross-border uh, settlement is significant. Disintermediating Visa, MasterCard. But there's so much more work to be done, and crypto is really evolving to this fintech 3.0. Those two worlds are colliding. Uh, and that's a kind of a maturity that's happening, the fact that those two worlds are colliding. So I think the main gap in the market I see around these areas is in the startup scene is there's not much direct to consumer. A lot of B2B this, B2B that. These entrepreneurs pay too much attention to the VCs, SaaS, B2B with machine learning, something. Direct to consumer seems underserved, and a lot of these business models are at risk from a new form factor. I posed this question over the weekend, like, what's the obvious opportunity that Robinhood and Coinbase are missing? I think the obvious opportunity is that they have got to refactor their UX to be AI first, AI native. Those consumer apps that have a lot of attention now, I think the user experience of these apps is going to change significantly, and that creates an opportunity for new entrants into the market and creates risk for incumbents. It's hard for incumbents to embrace that because they have to change what made their business successful. There's a classic book by Michael, it's called The Innovator's Dilemma by an HBS professor. He passed away. And the point is, if you're an incumbent, it's just hard to adapt. So what they typically do is acquire, and these companies have been very acquisitive. But I do think there's some gaps in the market around that. So we're going to go build that. I decided we're going to go build that. It turns out you can just go do things, right? Have you seen that meme? You can do things. So we're going to go build an AI first app, and we'll share that in a few months. We use all these tools internally. In fact, I'll share those tools with you later today. We'll go through some stocks or some tickers you want me to look at. Just drop it in the chat. I can pick up a few. We can go through and see how the AI looks at it. It's really an institutional grade approach that we take. So the key is skinning it down for a retail trading audience, and focusing on a very good user experience, simplifying complexity. So I think it'd be very powerful, though. I'm excited about that. More to come on that front. The other area I'm spending time around is in Alberta. Have you guys seen Landman? It's a really entertaining show. It's about a family in Midland, Texas, and it stars Billy Bob Thornton. It's about oil and gas. It's really entertaining. It's so funny. It's as much about relationships as it is about the oil and gas industry. So you can watch it with a +1. It's entertaining for everyone. They talk term sheets, they talk deals, they talk about the nature of the market and that category. So it's fun. You get education and learning as you see it too. I'm spending more time in Alberta. There's so much dislocation in that category that, we did a deal a few weeks ago that had a nexus with Alberta Oil and Gas. Essentially, the operator we teamed up with, this is a closed private deal. This is not an offer solicitation. It's not an offer, but I can walk you through the highlights of it. So the operator we teamed up with, we had a close relationship with them. One of their equity investors, one of our equity investors, had a very tight, what I call chain of provenance. And what they were doing is they are acquiring these oil and gas wells in Alberta. So you can buy these wells cheap, like 1.5 times price to free cash flow. It's kind of bananas. You can't find that in public markets. And the reason why these oil and gas wells are cheap is because Canada has been hostile to oil and gas for the last 12, 15 years, the Trudeau regime, and a very liberal government. That's changing now with Carney. Carney's adopting conservative policies, or liberal governments co-opting conservative policies. So, I was actually on the phone with an energy banker today. He's like, yeah, like the central government was trying to convince us to build like windmills, wind farms. Like we don't know what that is. We know how to get oil out of the ground and put it on a truck or natural gas in a pipeline. So, what's happened is a lot of capital and talent just left. Went to the Permian Basin in Texas. And so anyway, these oil and gas wells, the older they get, the more natural gas content they have. The natural gas is commingled with the oil. It's absorbed into the oil. Sometimes it's separated. Sometimes they're separated out. So the older these wells get, the more natural gas content they have. And the issue is in Canada, it's illegal to flare. It's illegal to flare. Flaring is like you have a teapot on your stove. You light up the stove, and you get natural gas flaring. That's what flaring is. Venting is you don't light it, just have the air come out. That's horrible for the environment. Flaring is much better for the environment, but still not as ideal as other methods. But you can't flare in Canada. So what happens is these wells, they emit too much natural gas to become liability because you're required by the government to seal the well. You have to seal the well, which means you have to spend hundreds of thousands of dollars in remediation costs and abandonment costs and environmental protection costs. So the oil well owner will sell it to you to get the future liability off their hand, even though it's cash flowing. Now, one man's trash is another man's gold. This is such a clever little strategy. I love it. So the operator we work with, what they're doing is they're taking these wells that have natural gas, but these wells are stranded. They're not attached to midstream pipeline. They're stranded. There's no pipeline that can convey the excess natural gas and sell it on the market. It's hard to liquefy gas. You need real industrial resources to do that. So what they do is they take a generator and they combust the natural gas on site and they mine Bitcoin. How brilliant is that? So they take the natural gas, they mine Bitcoin, and two, that allows them to access the oil. They're liberating oil and they sell the oil in the open market. I think it's a brilliant, brilliant strategy. So that was our last Lumida deal, by the way. So we'll share with you how it plays out. It's a 22-year deal because the wells are going to last 22 years. So we expect we'll get our principal out in year 2.5, and then free cash flow for the next 22 years. So pretty cool, pretty interesting opportunity. But I'm spending more time in Alberta. I think there's just a lot of dislocation. No one's talking about it. It's just my spider sense is activated around that category. Every 4 years, I sniff out these dislocation opportunities. One was buying non-agency RMBS in 2010, 2011, single-family rentals, the whole Blackstone trade in 2011, 2013. Buying these banks in 2023, examples like that. And so I think this is one of those. I think the world needs more energy, needs all of the above energy. And you're seeing policies starting to shift in the favor of energy, including Canada. So Carney, who seems like quite an effective leader, seems like a very impressive leader, just looking at from the distance, they're co-opting conservative policies, and they're very popular. One would think the Democrats might do that in the United States. That could be a winning playbook. I don't know why they don't. That should be what their strategy should be. Embrace markets, embrace capitalism. So here's a chart I want to share with you. This is a chart I like to trot out once a quarter. And if you're following on screen, by the way, we published this on YouTube, on Spotify the very next day. You can look up Lumida non-consensus investing if you're not watching live. So this chart shows the growth to value ratio. It's like growth stocks divided by value stock index over time. It's a great way to get perspective on the market. And what you see here is growth stocks are quite elevated relative to value stocks. Now, if you're not living under a rock, that should come as no surprise, right? You can see it in high multiple names have done extraordinarily well off the bottom. What I expect, and not what I expect, what we see now is value names start to outrun growth and just breadth expansion more generally. Okay, what does breadth expansion mean? It means multiple sectors in the S&P and the economy are starting to do well. It's not just tech, but it includes financials, it includes energy names you're seeing up today, includes even real estate names. Who's talking about like REITs? Includes like material stocks, includes, I mean, surprisingly, home builders and buildings and material supply companies are up over the last few months, despite softening data around housing inventories, right? So what I expect is rotation and, large cap tech to lag relative to these other categories, right? So I think rotations are afoot. You can see this in the markets today, right? Look at this style box, large cap growth, small cap value. This has been a familiar pattern, actually. I've been looking at this. We actually look at this from a factor perspective. We have time series across these factors. I can show you that if you guys want to take a look. But I expect more of that to happen. I still think that those large cap growth names can do well. There's still mispricings out there. Talked about Taiwan Semiconductor, talked about Google. There's still good names out there, and I think the data center theme still has opportunity, but you're starting to see movement in these other categories. So that's an observation I wanted to share with you. Earnings season is going to start next week. The banks will report, as they always do. I expect they'll report well. It's an incredibly benign condition for banks. There's no sign of recession. I just don't see it. I mean, how many months in a row does the non-farm payrolls have to exceed expectations? ADP data is noisy and not terribly predictive. And so, look, big picture, you're still in a bull market. I think you could have a situation in a few weeks where you get to fuller valuations. Maybe it's S&P 6,500, maybe it's 6,600, and then you chop or have a 5% pullback. Something like that could happen. But this is still a bull market. Those are tactics. This is a bull market. Earnings growth is robust. You just had this bill, which is increasing fiscal spending. That's all bullish, right? I wish they didn't spend that much. Like, you want to be counter-cyclical. You want to spend more in a recession. You don't want to run it hot in an expansion. Inflation's coming down. The Fed has more room to cut. I like the fact that the Fed's not cutting. I think it's very smart. This is a boomer economy, and it's a services economy. Boomers are spending their T-bill income. They're a big driver of demand now. They're gradually selling down their assets, and they're turning around their spending and consumption. That's why we talked about cruise lines not too far, I think 2 weeks ago. Norwegian Cruise Lines, that's up like 20% since then, by the way. That's been good. We still like those kinds of ideas. So let's talk about some specifics. How long? Some questions come in. Keep the questions coming, by the way. It makes it more interesting. I'm more of the view of assess and reassess. I don't like these long-term forecasts because you have new incoming data, and psychology and animal spirits matter, and policy, all this stuff matters, right? So it's easier to assess and reassess, just re-underwrite it. And you get a lot of volatility where prices can move substantially, 30% in 3 months, right? And so it's important to just reassess and re-underwrite and have a hypothesis about how things will unfold, what left tail risks you should be concerned about. Those left tail risks would be if inflation shows up in the data from tariffs. We haven't seen that yet. Have yet to see that. That's quite something. It's going to hit earnings, has to hit earnings, or has to show up in consumer spending. But where in the value chain does it hit? Right? But I think I think certainly through end of this year. I mean, like you have the Fed that's likely to cut at year end. The IPO season is still continuing. I still think we have more room to go in the IPO season. I think you're setting up for more Cathy Wood type dynamics. By that I mean like animal spirit kind of conditions where things get really frothy. Maybe in Q4, we'll see. So have to reassess. But this is a more resilient economy. This is a services economy. This is one of the first, really few times. We should check the data how often this happens where housing has been lagging, but it has not caused any recession. And that is because we have more of a services economy. It's a boomer economy now. It used to be that the way housing went was the direction of the economy. We haven't seen that. Market economies are dynamic. They're always adjusting. They're adapting. And I think if you're running the old playbook or on the inverted yield curve, or if housing went this way, you're going to be offsides. And the real tell is earnings. Earnings are increasing and productivity rates increasing. Those are two fundamental factors to look for. Those are going in the right direction. I'm certainly not a fan of tariffs, but I don't see it. I don't see inflation in the data. So if we see in the data, we'll take a look. And it's not going to be everywhere. Notably, if you recall, during the tariff Mageddon, insurance stocks were doing very well. They're lagging now because insurance stocks are pure balance sheet companies. So people are rotating away from there. And also defensives like Costco. Costco hasn't gone anywhere, by the way, like 9 to 12 months at a 50 times PE ratio. So I think what's happening is you're seeing those categories kind of leak and the liquidity flowing to other areas in the market as people get around to this economic expansion thesis. There's still a lot of people with PTSD, though. One of the advantages of being in our business as a wealth manager is I talk to clients. I get their perspectives, so I get a more visceral pulse of what's happening, which is super cool. I mean, we look at the survey data and the AAII and the Bank of America Fund Manager Survey and the positioning data and all these metrics. But when you talk to people, you can see it. And it's another interesting data point that I think is worth looking at. So, SaaS, tell us about how SaaS could AI impact this. Look, I think AI it really puts SaaS at risk. Software stocks outside of cybersecurity haven't really done too well. I mean, there's kind of just a lot of volatility. They're expensive, but that whole category is at risk from the rise of a new form factor. I saw this article that Meta made a bid to acquire Ilya, the co-founder of OpenAI, his startup, for $30 billion. They have no product, no revenue whatsoever. They couldn't acquire it, so they acqui-hired the CEO. That's something. It looks like Meta's making a bid to just poach talent. I think it has more to do with Meta's valuation and currency. Like, it's what you're supposed to do. If you've got a high currency, high market cap, do acquisitions, poach talent, because the prize for getting it right is significant. The prize for getting AI wrong is very significant in terms of the impact to your market cap. That was the whole CapEx receiver thesis we wrote about in 2023, which led to investments in infrastructure plays like CoreWeave, like NVIDIA, like Taiwan Semiconductor. Funny thing about semis, I think semis are actually pretty good here, right? I'll show you two names we own here. I don't want to really make this about semis per se, but it kind of led organically in that direction. But you remember ASML? This is a name we owned in 2023. I made a lot of fun about it when it won the Irisone conference in 2024 in April. It won the prize. Irisone conference is this legendary New York investment conference, happens once a year, sometime in the spring. And I was like, oh, damn, this thing is consensus. We have to sell now. We got to get out of this thing. I think we sold half of it, and then it topped in July. And semiconductors is a category which had become so consensus. Everyone owns semis. It just unwound itself. NVIDIA was a part of that. TSM was a part of that. ASML, Micron, all these companies. But I think that hangover is over. that hangover was technical positioning, sentiment driven, not fundamental in nature. Fundamentally, these are good businesses. They're on theme. Hyperscaler spend is there. Government spend is there. Sovereign spend is there. It's a legitimate opportunity. So, semis are not a bad way. So no one's talking about ASML now. So I think you should talk about ASML. That's what being non-consensus is. It's contrarian, but on a theme that's consensus, right? Look at things people are looking at in the theme, especially since the PE ratios for NVIDIA and these companies are getting higher. But I'll be very brief. But look, here's ASML. Not exactly cheap, but you're owning a business that is going to have to furnish all these new fabs that Taiwan Semiconductors standing up. So there's another competitor to ASML in China. So okay, fine, they're not going to get the China market, but I think that's okay. So another one that we like, this is more directly linked to packaging of Taiwan Semiconductor components, is ASX. I've talked about this before. I talked about this, some time ago. But what I like about it is the EPS growth. 4 PEs, 14 times, trailings around 22. That's a lot of EPS growth. 3-month momentum's 40%. This is it's a packaging company. So when they're involved in the supply chain for the shipment of Taiwan Semiconductor related products. So it's an interesting way to tag along. So anyway, I think those are interesting ideas. Although I'd rather talk about other stuff because, the interesting ideas are where no one's talking about. No one's talking about them. I love talking about those ideas, right? It's finding ideas people don't talk about, and they talk about it. And when people talk about them, that means they've already run up or they get on board. I like to be early to themes and then hang on for long-term capital gain. So here's one. Here's an energy stock, like a 2.5% position in this. It's called Riley Exploration. Unfortunately, it went up 5% today. I was hoping I could do this show yesterday or like this morning, but timing is a little off. Maybe wait for a little pullback. You'll get a good one here. But have you guys, if you've seen Landman and you want to invest in Landman, this is the business that you can invest in. This is like my Landman trade. I've known this business for a while, actually, but it's actually primarily a family-owned business, small cap, 619 million market cap. PE ratio is 6 times, 4 PE, 5.8 times. Okay, they're a driller, independent oil and natural gas, primarily Texas. And I'll tell you what I like about it. First of all, if I could point to one metric why I like this thing, maybe 2 metrics. One is this, the free cash flow to market cap yield. Okay, let me show you this. The free cash flow to market cap yield. I put this in the bucket of why do you own bonds when you can buy this? There are a few businesses like that I'll talk about today. Free cash flow to market cap yield. Take a look at this. So you don't see this in the stock price. You look at the stock price and say, oh, it's going nowhere. Actually, what's happening is I look at this and say, it's actually building potential energy because it's getting very, very cheap. The free cash flow to market cap yield is 21%. So this metric is you take the free cash flow generated by the company, not earnings, free cash flow. Can't lie about free cash flow. Earnings you can manage. You divide that by the market cap. In 5 years, this company returns its market cap and free cash flow. It's not bad. This is cheap. It should improve based on valuation re-rating to get to more normalized valuation. We can take a look at what that is too. And then also earnings growth. So it's actually better than a bond, and it's got an inflation hedge. So interesting, like on a PE basis, you might not see this as attractively valued because the PE is actually near the higher end of its range. But I think the value shows through in the free cash flow generation. So it's important to look at different metrics depending on what it is you're studying, right? So if you believe oil prices head higher, that there's a global expansion underway as central banks cut rates and commodity prices continue to rally, then this is an interesting way to get some exposure to that, to protect against inflation and create some diversification in the portfolio, because this category of energy often does well when other categories like cyclical consumer discretionary stocks, automobiles, airlines don't do well, right? Those, most of the world is fueled by energy. So when oil prices go up, energy stocks go up and the other stocks go down. So it's natural diversification. So I like that. I like that idea. We have that in our portfolio as well. Let me talk about insurance. So insurance, I mentioned earlier, this category has lag coming out of Tariff-Mageddon. It was a safe haven during the tariffs. Pure balance sheet businesses. There's no trade. People piled into these businesses, and they piled into staples like Costco. And since the ending of Tariff-Mageddon, they've kind of that tension is relaxed, and that capital liquidity has flowed elsewhere, right? So interestingly, these names are getting pretty cheap now. They're getting pretty cheap. And that question is like timing it. It's really about timing. From a long-term investor perspective, if you're an institution, I think you're supposed to be buying these guys now. If you're more nimble, you know, soon, maybe wait a bit, but like Allstate has a 4P of 9 times, trailing F13. Give me one quick second here. So yeah, I think there'll be a turn in this category. What you might want to look at is the insurance category index, KBWP index. Hasn't quite landed at the 200-day moving average. When it does, or if it drops 2 points before, usually that becomes kind of a new staging ground for a rally. The thing that technicians get wrong, by the way, is that when you're trying to do like a trend analysis on an asset that has a lot of free cash flow, it won't work because investors will step in, real money buyers will step in to buy those assets. Give me one quick second, sorry. All right, kids are causing mayhem here. So, Allstate, Progressive, interesting things to look at. If they, I'd keep an eye on them. I wouldn't say it's high conviction. It's something to watch. Something to watch. Other areas I'm looking at, by the way, I love consumer finance. I love the banks. I love non-bank consumer finance as well. I've been talking about this for a while. We just had tax cuts, income tax cuts for sub 150K. This is going to help consumer credit, and delinquencies are trending favorably. In fact, they're heading down for a number of firms across the credit spectrum. That's bullish. So I talked about Bread Financial last time. I have a number of plays on it: Synchrony, Bread Financial. 3, 4, 5 different stocks that we like in this category. Many of them are interesting. Opportunity Finance. There's a lot of names. When I see the entire tide behaving well, that gets me very interested. It means the theme is working. And what else? Even home builders. Let me show you home builders. I don't really have much exposure to this category, but I've been stalking this category. And look, markets look forward. Markets are discounting machines. Markets might be seeing a recovery in housing. Perhaps, we'll see. Mortgage rates are coming down, right? You take a look at housing stocks. The home builders index is up 18% in the last 3 months. I mean, a lot of things are up the last 3 months, but still, that's fairly notable, right? Higher lows. If you look at the building supply materials companies here, again, I don't own these. I'll tell you what I might want to own, but that's pretty good behavior to see. This is Builders First Source. Here's a name I used to own, which I like. MHO. This is our starter family home builder as well. So things are setting up in these other areas. There are rotations in the future. I think both of those are rotations in the future to take a look at. So we just kind of wait for them to set up, and then can position in those, especially in the summertime. These high beta ideas tend to lag, right? High beta is really what's been working the last few months. So rotating into these other categories, I think could be very interesting. What about defense? I talked about Eldos. That was our defense play. It's done really well. It's overextended now, though. That's the problem with Eldos. It's overextended. But I think this is still an interesting idea. I think getting it on a pullback is interesting. I like the valuation. I like the momentum. I like the earnings growth. Not bad. But overall, there are a lot of themes out there that are at work. Let me show you. I mentioned international banks at the top of this, right? You pick a country, I'll show you banks that are just doing really well. All over the world, banks are doing well. I don't think people are really talking about this enough, but let me show you a few banks. Let's travel the world, okay? How about Spain? You want to go to Spain? Spain is one of the best performing markets in the world, and Greece, by the way. These emerging markets. This is the ETF for Spain. Check it out. Look at this. Up 33% in 3 months. What's the leading bank in Spain? Banco Santander. There's a story around Spain. There's a macro story around Spain where mortgage rates are coming down, and there's more housing, and lending activities improving, the economy is improving. So there are good stories around the globe. Here's another one. This is a Korean bank. So mind the valuation. Check that out. 9.1 trillion, 8.5 forward PE. This is a 35% return in 3 months, 70% in 1 year, crushing the S&P. That's a value stock, by the way. That's momentum and value. So the people that say on Twitter you can't make money in value stocks are completely wrong. They're completely wrong. I can show you many of these examples. Barclays, Deutsche Bank, HSBC. It's going to be a similar chart. I'll show you one quick example. This is Barclays. 9.4 trailing, 7.74 PE, 44% last 3 months, 64% in 1 year. These are banks. Who said banks are boring? They're not. How about South Korea is another country now? Let's go explore the world. KB. So the funny thing about this one is we ran a screen last week. We're on the hunt for banks. I have an unhealthy relationship with banks. I grew up at banks. My last startup got acquired by a bank. I played a small role on a team at Merrill Lynch, acquired a bank called First Republic. That bank actually blew up. So I can't escape banks. Banks follow me around. They're incredible business models. Incredible. If you want to bet on economic growth and expansion, own banks. They're natural beneficiaries of all that. If you want to bet on deregulation, own banks. So this thing, unfortunately got ahead of us. It went up 5% today, but I don't know. I'll look for a pullback here. 8.9 trillion, 7.8 forward. Look at this, 88% return in 3 months. It's wild. This is in South Korea. This is a bank in South Korea. We can look at banks in Japan. They haven't run as strong, but they're doing fine. A good move is to own the leaders, right? Find the JP Morgans in these other countries. Find the leaders. Well-run, leading banks. The regulators have pushed so much credit risk out of the system. It's taken up by the private credit industry, right? So there's a bank we bought in Brazil recently. Not Nubank. I think Nubank is interesting, but not Nubank. It's like a boring bank. But yeah, who's talking about banks? I don't think people are really talking about banks. It's an interesting non-consensus thesis and idea. I think people, their heads just get wired to I have to own technology. I own technology too. I think you can own growth. You can own momentum. You can own value, avoid the value traps, right? Get free cash flow, get buybacks, get the leaders in their category. I remember Warner Brothers. I talked about this earlier today. I mentioned this on Twitter. Everyone's talking about Netflix. How about Warner Brothers? Look at Warner Brothers. Okay, it's up 48% in the last 3 months. Now, it's been a dog. It's been in a huge bear market since 2021 after the Warner Brothers Discovery acquisition. But if you believe that bear market's over, then the lows are behind you. That's a simple way I look at it. The lows are behind me. So then it's around just getting in the trend at an appropriate entry point. But I'll show you. Let me show you Warner Brothers. I'll show you Warner Brothers real quick. So I'll show you this in my AI tool too, because I keep talking about this tool. And unfortunately, I get too excited and I forget about it. But we'll come back to that. So check a look. So it's got a price free cash of 6.5 times, 40% profit margin. That merger they did a few years ago was terrible. So that's impacted their net income. That's old news, right? And what's our free cash flow yield look like? Why does free cash flow yield matter? Well, it matters. It's 15%. It matters because free cash flow lets you do a few things. One is lets you buy your stock. Two is it makes your stock attractive to investors because they know you can do things like that. Three is private equity can say, gee, I can go buy this company and use the company's own free cash flow to finance the acquisition. So free cash flow is a magical thing, right? If you look at the free cash flow on WBD, it's 15%. It's pretty high. If I look at a 20-year time frame, it's pretty elevated, and the price trend has been improving. It's got momentum now. So when I look at this, I say, hey, the market has changed its perception on the asset. It's had a gestalt shift. A gestalt shift is when you had one view, and then suddenly it shifts from the negative to an opposite kind of like polarity, right? So it went from you can't hate it enough to, hey, this is interesting. Something new is happening here, right? Think about like Nike. Nike's doing the opposite direction. I haven't looked at it recently, but it went from Phil Knight to why is this thing garbage? Or like Lululemon, they're going growth to value rotation, right? But you can go value to growth rotation, get multiple expansion and earnings growth together. That's pretty powerful. If you get both multiple expansion and earnings growth, if you're buying something that's got a high valuation multiple, it's harder to bet on yet further valuation multiple expansion. That's already behind you. You got to bet on that maintaining, and you got to bet on earnings growth, which gets harder and harder and harder as those businesses grow, right? And that's the issue with software right now. Software is kind of like in this hangover state. Yeah, I mean, it's had a decent recovery, but it's still, I don't know. But it's, I guess it's kept the pace of the S&P. It's up 26%. Maybe I've been too harsh on it. It's covered some ground recently, but not the biggest fan of that category. So, yeah, look, I think in the age of AI, licensing matters, right? The New York Times sued OpenAI around using their content. Now, the internet destroyed a lot of newspaper publishers, but this might be the era where proprietary content is king. Content was always king, always king. It's an attention economy, always was, right? So why can't New York Times prevail in that suit? Why can't New York Times strike a licensing deal like Reddit has? I think Yelp has too. And no doubt they probably are negotiating those as part of perhaps a settlement, but maybe the New York Times is asking for too much money, which is good for them. They're entitled to, right? But if you think about it, like the age of AI, brands will still matter, personalities will still matter, these icons will still matter. And if you can reimagine education and gaming in an AI first form factor, then the licensing opportunities for these companies, I think, is significant, right? I mean, that's not my underwrite for that stock, by the way. I'm just saying, like, if Disney had a better CEO, not Bob Iger, they would totally reposition their business around these kinds of, themes. They'd refactor their business. It's not about theme parks. It's about digital theme parks and digital content and digital avatars, digital education. So let me show you this AI tool. If you have a stock on me to run, let me know. I can run it for you real quick. This will run a bull bear case for me. I just picked Warner Brothers because we're talking about it, but this is fun. You can actually access these bull bear reports in my Telegram group, by the way. So, you can play with it. Just go to the, I think the transcript subchannel, but it'll give you a bull case and a bear case. It's highly structured. We designed it to represent analysis in this very specific way. We taught it how to think, what to look for from a risk and opportunity perspective also. So anyway, they give you some of the highlights: growth in subscribers, is the bull case, the IP library. The bear case is the debt. A lot of companies with a lot of debt are doing well recently. Perhaps because longer-term rates are coming down, perhaps because they expect the Fed to lower rates, whatever the case may be. But in general, they've been doing well the last few weeks, last few months. And what I like about this is that the AI tool will go through the transcripts of the company and highlight the key quotes from management. So you can see at a glance what's relevant, what matters. We are firmly on track to deliver at least 1.3 billion of EBITDA in 2025, says the CEO. We continue to see real growth, almost 4 million subscribers internationally last quarter. Strong subscriber growth is driving increased revenue and profitability. So then, the underwrite here is like, hey, can they pay the debt? I'll show you another feature here too. This is pretty cool. That's the bull bear case, but the other thing I like to use when I'm looking at a stock is we'll do a transcript analysis. The AI has gone through the last 5 filings, quarterly filings, and like a good analyst, it'll go through every transcript. It'll highlight sentences that are relevant: green, yellow, red, black, bold. It'll highlight that for you, so you know where to focus, because the transcripts have alpha. Transcripts have a lot of alpha, but they take time to process and read. This can be overwhelming, right? So, but then, how do I summarize what the highlights are? So we built that too. We said, you know what? There's a lot to read. Let's just summarize that also. So we did that with the summary feature here. And, it gives you the key ideas purely from the transcript. So they can tell you they're highlighting their subscriber ads, their CapEx, management guidance, again, highlighting key quotes, their outlook. So what my team and I are going to do is we're going to put all of that in an avatar format. So you can talk to an avatar and ask it questions, and you'll get prompted notifications on your watch list. It'll track for key changes, and it'll all be on an iOS app. I think we can build that in a few months. We already built this on the back. We use this stuff internally all day long. We have the APIs, we have the data. We've done the hard work. And if I get value out of it, then I have no doubt that the public will get value out of it. So stay tuned for that. Go to lumidaai.com. You get on the waitlist there if you want to check it out. We even have charting with the mark indicator. I mean, this thing is we went nuts on this. We went nuts. We love to build. And we're eating our own dog food here. Let me show you this real quick here. I'm more willing to kind of share this with the public because we're very, very close to launching it. So it's going to be hard for people to kind of reorient what they're doing. I don't know, pick a ticker, TSM, I guess. Now this is designed for institutions, not for retail traders, but we'll have to kind of adapt it for that. Did I get a bug on the time I'm doing a demo? That's funny. Maybe we'll come back to that later. So, but yeah, it's a pretty powerful capability. I'll show you, for example, the Grok news. We integrated Grok last week. This is pretty cool. So it'll go through real-time news on Twitter for stocks that we're tracking. It'll give me a green, red, neutral color. I can push a button, send it to my team on Slack, push it to Telegram, to our community. I can train the AI to focus on this more. I can sort by good or bad news by weights. We actually have an analyst go through the news, and they'll star the relevant news for us. So I can focus my attention on what matters. Every time the analyst stars the news, we're training an LLM in the background to identify that as material news. Right? So this is an example of how AI is transforming investing. Check this out. This is another feature while we're at it. This is another feature. This AI will go through the front pages of the Wall Street Journal, Bloomberg, Financial Times, CNBC, Politico, Healthcare, Defense News, American Banker, grabs all the headlines, organizes that, synthesizes that, finds themes. It looks at prices and asset prices. And then I get my own front page around what matters, tuning out all the noise. Super, super cool. So these are just illustrations how AI is going to transform investing, just to bring it back full circle. Like, if, I think the opportunity set, if you're an entrepreneur or you're a builder, is significant. You should really take advantage of that. VCs are throwing money at founders to build AI. Join a fast-growing company. Just join a fast-growing company. Maybe you're unsure of your business building skills. You've never done it before, and yeah, it's hard work. So just join a fast-growing company. I have many friends who just took the path less traveled. I have a buddy of mine who started as a controller at a company, and then he became the CFO after a few years. Small, privately held company doing $1 billion in revenue a year that no one ever heard of, selling digital products. You've all used their products probably, you just don't know the company that makes them. There are a lot of stories like that. Just join fast-growing companies and, start, bringing it back to what Ray Kroc said. This guy, founder of McDonald's, created an extraordinary amount of millionaires, owners and operators, his franchises, following the playbook, shareholders, and all the rest. So capitalism works. Hope that was fun. All right, ASPI. I'll be brief on this one. Can you run ASPI? I can run ASPI. I don't know if ASPI is stock I wrote about last year. It's done very well. I think we wrote about around $3 and $2.50, and it went up to $9. I think now it's like $7. Right? Uranium play. So I would say this. It's good to see a bid today. The thing with a name like ASPI is I would look at how uranium is doing as a category, because it's going to trade in a correlated way with that, as well as its peer group, like LEU, Centrus Energy. So it's very hard for me to give you views on those things. They're so dynamic. They're so volatile. So it's like what I might say today could be outdated. But those things tend to trend, sometime in early October, those themes tend to work pretty well, I would say. I don't know if that's helpful for you, but there's some other small caps we're looking at, micro caps, that are interesting, where most micro caps are garbage. A lot of small caps aren't that great either. But if you can find good businesses, there's definitely an opportunity for mispriced assets that are out there. So I highlighted a few of them today. We'll have more in the future also. All right. Hope that was fun. Thanks for listening. Again, you can follow along on YouTube or Spotify. Look up Lumida, non-consensus investing. Again, this is all pure entertainment, not financial advice. Make a great week. Be well.